what has been interesting is that if we look out over the recent data that we've been seeing over the last 6 months, actually what we should be starting to see over the next quarter or so is actually a downturn in earnings growth. That is what all the economic data is pointing to. But interestingly, earnings expectations are not reflecting that. So if you look at what the market is anticipating, they are expecting a continued upturn in earnings growth. So for us, that's telling us that there is potential for market disappointment. So another reason for us that we're going to continue to be quite cautious going forward.
Yeah, you've got a slight underweight there as well, haven't you? But it's a slight underweight, isn't it?
It's a slight underweight, yeah.
I'm really interested in where you're finding the money in order to change your portfolio slightly. And I noticed that you're shifting your alternative positioning from the slight overweight it was on to a neutral. What are those alternatives? Actually, no, first of all, tell me what those alternatives are.
Yeah, so it's an interesting discussion with this one, because actually when you look over across alternatives, the big benefit of them is that they're a big diversifier against traditional equities and fixed income. And given what I'm saying, actually, maybe traditional equities will be quite challenged over the coming months. The other part of it is that alternatives typically are made up a lot of real assets. And for us, actually, real assets still deserve to have a place within the portfolio. But when you start to look through a couple of the components, so commodities, natural resources, REITs, actually those, for the near term, their outlook is a little bit challenged. So for commodities, as you were talking about earlier, the growth downturn that we're anticipating both in China and the US should mean to us that there could be further downward pressure on commodities and natural resources. You look at REITs, well, the REIT sector continues to struggle because of this return to office downtrend that we've been seeing, as well as the fact that it's very interest rate sensitive. So until you see a peak in Fed rates, REITs may continue to struggle. Then on the other side, that is a little bit offset by infrastructure, which for us continues to be one of our favourite areas. You get the inflation mitigation, you get the consistency of earnings, and in a slowing economic environment, that is typically where you want to be positioned.
What about hedging the inflation risk from here? And what's the path ahead for inflation? Because the last print obviously has given market enough confidence to say, okay, this is the time when the Fed pauses, or at least signals a pause, heads for a pause. But I'm a little concerned about what happened in the soft commodities market all of this week because of the Black Sea grain deal falling through and what's happening with nat gas prices, right, the energy prices. So that component on the supply side, which kind of got dealt with over the last, 2-3 quarters, do you think it's going to come back to haunt the Fed on supply side issues?
So it's actually a really, really important point that you brought up. So we have seen, of course, headline inflation come down to 3%. That has typically been the year-end forecast for a lot of analysts out there. To hit that mid-year has been a bit of a surprise. But we are expecting you to see a little bit of a pickup in headline inflation as you go through the next couple of months, simply because of base effects. Now, core inflation should see a continued deceleration through the various, the economic slowdown. But as you said, one of the things that I think the market has become quite complacent about is what happens to commodity prices going forward. Now, as I've just said, I think the economic growth downturn is going to put longer downward pressure, but there could be spikes because of some aspects around climate change. You just have to look at the European fires, what's going to happen to a couple of the river levels in Germany, and you can see that there could be some issues there. So there is volatility going forward. It does mean for us that whether you believe there's going to be a further deceleration or not, this is going to be a fairly slow deceleration from here. And you should continue to have some kind of inflation protection within your portfolios, which is the main reason why actually we continue to like infrastructure.